very commonly made mistake by small business owners is the wrong choice of legal entity for their business. The three primary types of entities you're going to want to consider as a small business owner are going to be an LLC tax as a partnership, an S corporation, and a sole proprietorship. So first, let's talk about a sole proprietorship. Sole proprietorship is just you. For legal and tax purposes, there is no separation. Don't even think of it as a separate entity. If you get sued, that's you getting sued, and likewise, when you file your tax return, it's going to be reported directly on your Schedule C of your 1040. So next, we'll talk about the LLC tax as a partnership versus the S corporation, because that's going to be the real decision you're going to be making. An LLC tax as a partnership is generally advantageous if you have significant appreciating assets in your partnership. The reason for this is when it comes to distributing the assets out of the partnership, you have to recognize gain when you do it from an S corporation, whereas with a partnership, you generally will not, though there are specific tax consequences that can contradict that. But with an S corporation, you will always have to recognize the difference between your basis in the asset and the fair market value when you distribute it to the owner, and you do not have to do that with the LLC tax as a partnership. And that's what you want to focus on. S corporation, on the other hand, has a very distinct advantage, and that's for the owners that are receiving wages from their business. With the S corporation, the only portion of their income that's going to be subject to self-employment tax are those wages paid to the owner. A partnership, on the other hand, you can't pay yourself wages as an owner. So you can save yourself about 15% in taxes, as the only part that's going to be subject to the self-employment tax is that wages with the S corporation, whereas with the partnership, all of your income is subject to the self-employment tax. And lastly, with an S corporation, you can generally have one owner that's filing its own 1120S, and you don't have to worry about putting some other kind of ownership structure on there to get it off your 1040. The last thing that I want to talk about is whether or not you should make estimated tax payments. We frequently get this question from our clients. Now, when it comes to estimated tax payments, what you're doing is you're paying in based on either your current year income, or there's a safe harbor for your prior year income. If your prior year income was over $150,000, you need to be paying in at least 110% of what your tax liability was on the prior year. When it comes to under $150,000, you can just pay in 100% of your prior year tax liability, or you can pay 90% of your current year tax liability. So what that means for tax planning purposes, you're generally just going to be paying in 25% of either 110% or 100% of your prior year tax liability. So the last thing you want to decide is whether or not you should even make those estimated payments. Now, that's a personal question that only you are going to be able to decide with your assessment of the time value of money. There is a cost for underpayment of estimated taxes. However, it is generally low depending on the state that you live. But for federal purposes, while the calculation is kind of complicated, it comes out to around 2 to 2.5%, but it is based on the quarters for which you're underpaid. So it's not a significant cost for underpayment of taxes. However, if you have an investment that you think you're going to be getting a greater return than that cost for your underpayment of estimated taxes, many clients will just decide, I'm not going to make my payments at all. I'm just going to pay the penalty because I'm going to get a better return for my money invested in the market currently. And that's kind of where you'll want to decide between paying your estimated taxes or not. But of course,